For those of you who don't know, dividend investing is my favorite way to build wealth. You can use it in plenty of different ways. You can use the income to pay bills, to reinvest with the dividend snowball, which is the method that I use personally, or you can just pull them out and do whatever you want with them. And I think the flexibility of dividend investing is so exciting. So today I wanted to talk about an article that I found that has 6 simple rules for dividend investing, and I wanted to give my thoughts on them because I think the simpler you can keep investing, the better. If you can have set in stone rules that are pretty easy to follow and they don't have a, ooh, should I do this right now? Should I do it right now? The more successful you're going to be in the long run. And that's why I've had my own rules, and I kind of wanted to look at these and kind of give my thoughts on them if I think they're worth incorporating into your dividend investing strategy. Let me know down below what strategy you use and kind of the main philosophies that you use for building wealth using the dividend snowball or whatever you use. And if you don't use dividends, let me know why down below. So the first one from this article, which I'll have linked down below, is choose quality over quantity. One of the most important considerations for investors when choosing investments is the dividend yield. The higher the yield, the better the return, but the numbers can be deceptive. If the stock's current payout level is not sustainable over the long term, those market-beating dividends can quickly dry up. REITs are a good example of how fluctuations in the market can directly affect dividend payouts. The REITs are the real estate investment trusts, which are a type of company that are required by law to pay out a certain amount of their income in dividends. That's why a lot of the REITs that you'll find, the most famous one being Realty Income, which is ticker symbol O, which is a part of my portfolio, are required to give out a certain amount of payout, which is why the dividends are great. But I think this article is referencing the fact that during the pandemic, when the housing problems were happening, they had a really tough time. And those are the market fluctuations that can cause really high dividend paying stocks to either cut them or pause them altogether. We've seen some recent examples. I think I saw a bank announce on Friday that they are pausing their dividend. But I think this is a really good rule, choosing quality over quantity. And it's something that I talk about in my specific rules, is that I'm looking for a dividend yield that is below 4.5%. Yes, you can find dividend yields that are much higher than that, and people will say, well, why don't you want a higher dividend yield? The main reason is I think it's too risky. Dividend yields can be a double-edged sword. You have the positive of, yes, you're paying out a lot of money, but I need the longevity. You want to see the company reliably increasing their dividend yield over time, and that makes it a dividend aristocrat or a dividend king. But if they push it up too aggressively early on, it may not be sustainable, especially if the stock price falls continually, because the dividend yield is determined based off of the current price of the stock, and it doesn't matter what it's done in the past. So that's why I like to keep it below 4.5%. That is the highest I'll pretty much go, just because I want my stocks to appreciate in value as well as have a nice dividend. So I want to pick quality over quantity, and the number being high is not necessarily a good thing, but some people may disagree, and let me know what you think about dividend yield. Where's the cutoff for you down below? Now let's go to rule number 2, know when to hold them and when to fold them. Fantastic. Investing guru Warren Buffett firmly believes in taking the long view when it comes to investing, but like any smart investor, he knows when to cut his losses. With dividend stocks, there's a fine line between waiting for the reinvestment to pay off and hanging on too long. This is a really difficult one to deal with because there's a lot of emotions tied up with losing stocks. And I think if you're picking stocks that meet a certain criteria and not basing them exclusively off of, some random YouTube video or just kind of the vibe you've seen with the dividend yield, you won't have this problem. I very rarely have a situation where I look at one of my stocks and I'm like, ooh, I'm kind of tempted to sell because it hasn't been doing very well. Every stock in my portfolio is there for a specific reason, and if that reason hasn't changed, I don't even consider touching it. If I do consider selling a stock, I give myself a week where I have to sit down and kind of think about why I'm selling and give myself some time to kind of justify why I'm doing it to make sure it's not just an emotional response. Because we want to avoid panic selling at all times. You can have the positives of panic selling because you get the tax loss harvesting, but we want to stay in stocks as long as possible, and if we don't need to sell, we want to avoid selling at losses at all costs. So I do think that, yes, you got to know when to hold them and when to fold them, but I don't even consider selling unless something critical happens, whether it be a change in business or something really critical with the business changes, whether it be a pause in the dividend, that could cause me to sell out of a stock. But besides that, a bad news story, I just kind of shrug it off and go on from there. So rule number 3 from this article is sticking with established companies. The stock market moves in cycles and it has a tendency to repeat itself now and then. When choosing dividend investments, there's no better measuring stick than a stock's past performance. Specifically, investors should be targeting those companies that have dividend aristocrat status. So dividend aristocrats are companies that have been paying out and increasing their dividend annually for the past 25 years. It doesn't mean that their percentage has gone up, it means that their payout has gone up. So you'll see some companies that just have a 1 cent increase in the dividend. Not super exciting, but it continues on their streak of raising the dividend, which is critical for dividend investors. So 25 years as a dividend aristocrat, going up to 50 years, which is super exciting, makes it a dividend king. And I 100% agree with this. I only look at companies that are dividend aristocrats or dividend kings, just because it gives you that track record of knowing how the company's done. You always have to mention that past returns are not indicative of future returns, but they're a pretty good example to see how a company's done during really tough times. You want to see how a stock has done during high periods of inflation? Look at how the stock did during the 1980s when inflation was, 1.5 times what it is right now. You want to see how companies have done with financial pressure? Look how they did in the last recession. Using the past data, you can look to see how a company has done during previous areas of tough market conditions. And because of that, you can feel much more confident in the long-term success of a company. A company can come off, look super exciting, pay a really high dividend, but if it hasn't been doing it for very long, I'm a lot more nervous going into the first recession with that stock versus a company like, Home Depot or Procter & Gamble. It's been around for a long time. I'm much more confident in holding them for the long term, which goes along with rule number 2, is it protects me from having to know when to hold them and when to fold them, because if you're buying established stocks, you don't have to worry about that as much. So I'm gonna kind of stick rule number 2 and 3 of theirs together. I think those are fantastic, only buying established stocks. Number 4 is looking for growth potential. While newer companies can pay out impressive dividends, investors shouldn't be reaching on the bandwagon without doing their research. Aside from looking at past and present returns, it's also important to look at the company's future potential to increase its dividend payouts. When I look at this rule, at first I'm like, ooh, I don't like that. Historically, normal investors are awful at predicting growth potential with stocks. We don't know what's going on behind the curtains, and we are really bad at either predicting what's going to happen in the overall market or seeing growth potential. People who say that they're good at it, probably lying and just got lucky. But the growth potential they're talking about here comes from the dividend payouts, and that is critical. This comes with the payout ratio, which is the ratio of the dividend payout over the amount of earnings that they're bringing in, and it's a percentage. So the higher that percentage is, the less healthy the dividend could be depending on who you're talking to. Some people see a dividend yield or a dividend payout yield sitting around like 80%, and they start getting worried. I don't really care about it that much. I'm listening to see what the company's saying. If they're comfortable with their dividend at a certain level, I'm cool with that. Growth potential doesn't really worry me in the slightest, because I'm picking stocks that have the track record of outperforming the S&P 500 over the past 25 years. So I have the growth potential based off of what it's done in the historical trend, and I don't care about trying to predict what stock is going to have, the best 5 years, because we're not buying into growth stocks, we're buying into dividends, in addition to having the appreciating asset of the stock. So I look at track record. I'm not trying to predict the growth potential of a company. And the dividend payout, if the company thinks that it's healthy, I'm cool with that. The higher the number for the percentage, the more worried you should be, but there's not a certain number where I look at and go, ooh, I'm not going to touch that with a 5-foot stick. So rule 5 kind of goes along with this as well. Be mindful of the payout ratio. The company's dividend payout ratio can reveal how safe the investment is. This ratio tells investors not only how much is being paid out to shareholders, but also how much income the company can retain. If you come across a high yield dividend stock, but the company is paying out a substantial percentage of its income to investors, that's a sign that you need to tread cautiously. So the caution that they're mentioning here is that they're paying too high of a dividend, and either they're not going to be able to increase it to continue on their dividend aristocrat status, or to hopefully reach that in the future. And you can come into a dividend trap where the company is paying too high of a dividend for what it can healthily pay out, and it means that it's likely going to have to cut it in the future, which is usually a huge hit to dividend stocks. The most recent one I can think of is AT&T, which has had a really tough time in the past 5 years after they announced a dividend cut, just because they weren't making that much money and their payout ratio was much higher than they could sustain. As I mentioned in the last rule, not something I'm super worried about, but you can get to a point where you see a payout ratio and you can see that things are going poorly. That might be a reason to sell out of a stock, but it's tough to kind of look at for a normal investor like you and me that doesn't have hours and hours to spend looking at this stuff. Rule number 6, and the final one, mix it up. There's a strong argument to be made for concentrating assets on a handful of stocks or targeting a specific sector of the market. If the companies or industries you've zeroed in on have exceptional track record, that bodes well for your future dividend earnings. On the other hand, that can be problematic during a market downturn. Spreading assets out over multiple dividend-paying instruments add diversity to your holdings and allows you to minimize risk. When dividends are reduced in one area, the loss may not be felt as deeply when the rest of your portfolio continues to perform. So I think this is smart. For people that are investing in the stock market, it's much easier to just buy into the same sector, especially if you're pretty knowledgeable on that topic. For younger people, a lot of the times it's tech companies. Tech companies historically do not pay out great dividends, so it puts us in a different area because it's not as easy to just go pick your 5 favorite stocks because likely they don't pay dividends. But if you're looking at a portfolio and you're looking at the Dividend Aristocrats, it gives you a wide variety of different stocks so that all of your eggs aren't in one basket. The worry is that you put all of your eggs into the tech sector and then you have a microchip problem and now all of your stocks are down at the same time. We're trying to limit risk while also buying stocks that are going to do well over the long term. So we're going to try to spread them out. That's why my portfolio has a nice mix of investing in different industries. You look at, you have tech with Apple and Microsoft, which have a much lower dividend yield, but they have a historical trend of being incredible winners when it comes to their appreciating value of the underlying stock. Then you have energy and renewables with NextEra Energy, retail with Nike, pharmaceuticals with AbbVie and Johnson & Johnson, and the list goes on. And I have a nice spread out portfolio where if you have one bad news story about, say, tech, I'm not gonna be hit that hard, but it still allows me to benefit if the overall market goes up because I have a nice spread of stocks. And that's why I kind of have the diversification that I have. There's no specific number where I think, oh yeah, you should have 12 stocks, that's the perfect number. I just like to spread it out. I like having a little bit of a lot, I guess, just so that I get dividend payments from a lot of different companies. And if one stock does really well, I'll benefit from it, but I like the spread. So overall, when I look at these rules, I think most of them are pretty good, but I wanted to solidify and kind of share my 4 rules that I have that are critical for my success and why I have turned a profit on my portfolio, even though the stock market is still down from its highs. Okay, so hopefully this looks the same. My video for some reason cut out, so let's try this again. But here are my 4 rules that I have for dividend investing. We talked about in this video 6 different rules that this author has to be a successful dividend investor. And I think that's fantastic, but I think it's important to have really set in stone rules. And these are the 4 rules that I use, and I'm curious if you think that they're rigid enough or not rigid enough, and let me know your thoughts in the comments down below. Number 1, it has to have outperformed the overall market since 2000. 2000 is just kind of an arbitrary date, but the reason that I picked that date is that it shows kind of a variety of market conditions. 2000, you have the dot-com bubble bursting, so you have a lot of the tech stocks selling off aggressively. Then you have the Great Recession in the middle of the 2000s. Then you have the dot-com, we already talked about the dot-com. Then you have the pandemic stuff. And so you have a different view of market conditions to see how these companies have done over the past, gosh, that's 25 years now almost. And I want a stock that not only pays out a nice dividend, I want it to also have outperformed the overall market. We're not buying dividends just because they're fun and we like getting that extra ka-ching in our bank account every once in a while. We're doing it because we think that it's a reliable way to build wealth. And if it's just easier to buy the S&P 500, we might as well do that. We're buying individual stocks because we're trying to outperform the overall market. And so having beat the overall market since 2000 is very important to me, which is why I put it number 1 on my rules. Number 2, it has to be a dividend aristocrat. I'm not going to be buying a stock that pays out a 9% dividend that has only been around for 3 years. I need the track record to see how the company is done while paying out that dividend. It kind of goes along with number 1 of 25 years of the stock market returns. This also shows that their dividend health is healthy enough where they can pay it out reliably for the long term. And so a dividend aristocrat, or even better, a dividend king, much better. I just want to be able to see that they've paid out the dividend reliably and increased it. It's a dividend payout, not the yield. Payout, you can go from 25 cents a quarter up to 26. But if the stock price has gone up, most of the time, if the stock price has done well, the dividend yield has gone down. That's okay with me. It's just the dividend payout has to go up, which is how you get dividend aristocrat status after 25 years. Rule number 3 is that the dividend yield has to be below 4.5%. You might wonder, why don't we want a high dividend yield? You can have too much of a good thing. Dividend yields are exciting, but I want it to be at the point where I'm not like, okay, well, this is great, but something's got to give. We don't want to invest in dividend traps, which are companies that pay out a really high dividend, and either the stock price hasn't gone up in addition to the dividend yield, or it's just that it's not a healthy dividend and will likely need to get cut in the future. I always think about AT&T that was paying out like a 7% dividend, but you looked at the health of the company and the returns, and the stock price had actually gone down during that time. So you would have lost money even though you're buying into a stock that has a 7% dividend. So we want to avoid that at all costs. The 4.5% is kind of an arbitrary number. That's just kind of what I've seen of the companies that are stable enough where you can invest in them for the long term and I'm not worried about it. And it's high enough where I'm still excited by it. So I think AbbVie is probably my highest payout. Most of them are probably sitting between 2.5% and 3%, but 4.5% is kind of my cutoff, but it's kind of an arbitrary number. Number 4, and the last one, is going to be the basis of all of my investing strategies, and that's going to be dollar cost averaging. I feel like dollar cost averaging and dividend investing just kind of go hand in hand. The whole idea of the dividend snowball is that you're investing in dividend stocks, and when the dividends get paid out, you're buying right back into those stocks, no matter what the price is on a reliable time frame, which is dollar cost averaging. Woohoo! So if you look at my history for the past, year and a half, I think I've bought into the market like 85 times in like 60 weeks. So I'm constantly buying in, and I'm just buying the dip. I'm just buying whenever I have additional funds, and I'm not worried about trying to pick the perfect time to buy into a stock. And so dollar cost averaging is a must, because the more value you can get, the more yield on cost that you can get from these dividend stocks. So if you can buy a bunch of a stock down 25%, that 25% off is going to be super nice when you're getting those dividend payouts based off of your yield on cost, which is not something I talk about a lot on this channel, but it is something to kind of consider. So the dollar cost averaging is super important at the basis of all of my investing strategies. So those are my 4 rules. I kind of summarize them one more time. Has to have outperformed the overall market since 2000, has to be at least a dividend aristocrat, a dividend yield below 4.5%, and dollar cost averaging is a must. Let me know what you think about my rules, and let me know how your dividends have done over the past year. And if you don't own dividends, let me know. And if there are topics you'd like me to discuss in future videos, be sure to let me know. My voice is shot because this is the second time I've had to record this, and I am sick. So I really appreciate it if you hit that like and subscribe button, and I will see you in the next video.